Hi, I'm Albert. Today, me along with my partner Rachel would like to discuss on the topic of subprime mortgages financial crisis in 2008. It is important to know what is actually meant by subprime mortgages before further explore into the subprime mortgages financial crisis that terrified the whole world in year 2008. According to the dictionary, subprime is a descriptive word associated to individual with a poor credit rating. For instance, if an individual never clear his or her credit card balance timely or have a bankruptcy history, then that particular individual will definitely have a poor credit rating. The poor credit rating individuals are precluded to apply for normal housing loans or credit applications. They are disqualified on the grounds that they have higher possibility of not able to serve the monthly installment due to their poor record. However, the banks are very innovative in the sense of launching various types of product in order to capture every single type of customer, especially in the current very competitive environment. In this case, they come up with a special type of loan to this group of people with spotty credit histories. This loan or mortgage is called subprime mortgage or subprime loan, which the monthly payments have much higher interest rate than normal, since the lenders view the loan as much riskier. Therefore, this was how the subprime mortgages been created and launched, which eventually caused the awful subprime mortgages financial crisis in year 2008. In this part of presentation, we will discuss on the few factors that caused the subprime mortgages financial crisis to occur in 2008. First of all, the American dream. Owning a house is a piece of the American dream. It enables individuals to take pride in a property. However, houses are very high priced, which easily can sell at few hundred or few $1,000,000. Therefore, in reality, majority of people need to source ways such as borrow money from banks to purchase their dream. However, in the mid-2000s, that fantasy came into reach for the Americans. House loan interest rates were low, enabling buyers to get their requested credit or even more with a lower scheduled installment. Moreover, in the same period of time, the price of the houses has increased significantly. So in general thinking, purchasing a house appeared to be a certain vigor. Banks trusted that houses were the safest profit securities. Therefore, they were more than willing to provide housing loans to everyone and earn lucrative income while everything was good.
Alright, thanks Albert. So I will be covering up for the second part, the second factor, which is the increasing of subprime mortgage and loans lending. As from previously what Albert said, the home ownership became the major factor of the rise of subprime loans, so especially in the year of 2008. This eventually risen the price of housing in terms of their consumer spending, which further brought into a higher inflation rate for the period of time. So, as with the effect of housing bubble keep on rising, the bankers soon come up with a plan named which provide the mortgages, which is so-called the subprime loan, which tentatively focus on the high-risk borrowers with lower income and poor credit rating background category. Alright, so as mentioned, these are all we call subprime loan. category. But somehow, not everyone will be fulfilling with the criteria to own a mortgage. As when in this happening, so when the dramatically increase of the amount of subprime mortgage, this consequently putting more risk for the lenders to bear, and due to the rising of real estate and housing bubble effect. There are also some say that the creation of a lot of subprime mortgages had eventually spiked up the lenders' behavior on seeking other investment by bundling their loans and transform it into the security which were further sold to a pension fund or security that could give them a higher profits by selling higher price of their security. So they basically take advantage on from getting the subprime loan and then they sell it. Alright, so next we'll be discussing about the subprime loans. The increase of the subprime loans due to the increase of the Federation fund rates. So during the economic recession in 2001, the Federation has further lowered down the Fed fund rates to 1.75%. They even further lowered down it in the next year to 1.24%. This has actually consequently lowered down the interest rate of the market as well as the loan and mortgages, especially those who are in adjustable rate features. Therefore, the repayment of the loan and mortgages were consecutively cheaper due to the lower down of the interest rate in such short-term period if compared with the short-term treasury bills, which as a benchmark in the market. The home buyers who are neither in prime or qualified category of loan mortgaging were actually pleased with these low interest rate loans. As further on, the high rising of subprime mortgages and loan become higher and higher from 10% to 20% between the year of 2001 to 2006. It pumped in a total of $1.3 trillion of business profit into this industry. With this consequent effect, the buyer did not realize that the rate was actually short-term, as due to the Federation was the decision maker for controlling all these activities. The loaners did not aware of the rising of fund rates, which the rate started to rise till the period of 2006 from 2.25% to 4.25%. It even reached the highest rate of 5.25% in the year of 2006. As such, the loaner and the homeowner could not afford to pay up such high repayments. So this rate is even rose faster than the previous period. Alright, the next factor that eventually rising up the subprime loan is actually the transformation of securities. As mentioned previously, the mortgage transformed security is a financial product which the price is actually based on the value of the mortgage that are used for collateral. Once you get a mortgage from the bank, it sells it to the hedge fund on the secondary market. And then further on, the hedge fund then bundle your mortgage with a lot of other similar mortgages. They use the computer models to figure out what the bundle is worth based on the several factors. For example, the monthly repayment, the total amount, the likelihood, the repayment schedule, and the future home prices. As moving forward, the hedge fund then sells the mortgage transformed security to investor. As bankers here were still the major player in selling the mortgages transformed security. They can actually make a new loans with the money they receive from the investor. The bankers may still collect your repayments, but this brought them along with the hedge fund who send it to their investor. Somehow, the investor were not so worried about it, as they have actually insured by the insurance company which provides several types of coverage protection in the investment. This type of coverage and insurance able to cover up wide range of investors who holding financial instruments for example, hedge fund and individual investor and pensions funds, etc. Thus, when it became a lucrative business in the combination of real estate and insurance, this has actually risen up the demand for the mortgages, transformed securities, as the risks were covered up by the insurance company. And when the bankers were about to seize this great opportunity to make money, the bankers loan and provide the bankers loans and provide mortgages service to everyone, as they made so much of money from the derivative rather than the loan themselves. Alright, so last but not least, the rising of the credit rating agencies had eventually risen up the amount of subprime loan as well. So as what we know from the name, the credit rating agencies are the party who are giving investment grade ratings to the securities transaction who are in the category of subprime mortgages. The higher rating theoretically were due to the multiplier independent mortgages held in mortgage-backed or mortgage transformed securities, according to the agencies. However, some would not actually recognize the credit rating agency as a true benchmark, as there was a conflict of interest between the companies and agency, due as the rating agency are paid by those companies who selling the ratings report to the investors, such as the investment bank. For instance, as of November of 2007, the credit rating agencies had further downgraded over 50 billion USD in highly rated collateralized debt obligation, and more such downgrades are possible. Since these certain types of institution investors are allowed to only carry high quality assets, there is an increased risk for the force of asset sales, which could cause further devaluation. The rating agencies such as Standard & Poor's, Moody's Investors, and Fitch Ratings have come under fire for being slow to lower their ratings on security based on the mortgage loan to US borrowers with poor credit records.
Next, I would like to discuss on who were actually the main culprit for the subprime mortgages financial crisis in 2008. The subprime mortgage crisis, which guided us into the Great Recession, has many parties that can share blame for it, especially the lenders as well as the investment banks. After the lenders approved and gave out the loan would be sold to an investment bank. The investment bank would then partner this mortgage with other similar mortgage for other parties to invest in, and the lender would, as a result of the sales, have more money to use for home loans. It is a process that had worked in the past, but the housing bubble saw an unusually large number of subprime mortgages approved for people who struggle with credit and income. When the Fed began raising interest rates over and over, those loans become more expensive, and eventually the borrower found themselves unable to pay it off. It was very obvious lenders were far too ready to give away so many risky loans at once, seemingly assuming that housing prices would continue to rise and interest rates would stay low. Same goes to the investment banks. They seemed to have similar motive, getting bolder with their mortgage-backed security investment. Therefore, the lenders and investment bank were the parties that should take the most blame for their over-positive and aggressive attitude or behavior. In this part, I will discuss on the effects of the mortgage crisis on the stock market. when the mortgage market meltdown in 2007. It had a much broader effect than plummeting home values. As mortgages went down, they also combined with other broader economic issues to shut down credit markets and cause the stock market to lose value. On 20 November 2008, Dow hit 7,552.29 and eventually bottomed out at 6,547.05 in early March 2009. For your info, Dow had reached 14,000 in July 2007 before the mortgage crisis had truly hit. The reason behind the huge drop on the stock market index is because the mortgage crisis caused a lack of confidence in the financial system and the economy. The mortgage market is a major part of global finance, and finding out that it was on shaky ground scared investors. In addition, the loss of housing value and the inability of homeowners to pull money out of housing led to a recession that stalled corporate growth, further causing prices to plummet. Many financial service firms either disappear or were swallowed up in mergers at discounted prices, wiping out billions of dollars of shareholder value. For instance, Lehman Brothers was one of the victims in this financial crisis. This company was filed for bankruptcy on 15 September 2008, which has shocked the global world. In conclusion, subprime crisis happens because everyone predicts the property value will appreciate over the time. The economy now is no longer as simple as in 30 years ago, where we can predict the future with certainty of accuracy. Future is getting harder and harder to be predicted for the coming years. The only things that we can do is learn from the past and always be well prepared for any kind of uncertainties. With this, I would like to conclude our presentation. Thank you.